Viewers, all eyes are out on what do the additional tariffs mean for India. And I think we're trying to speak to as many global voices to try and understand how do they think about it. Somebody who looks at India very closely is Trinh Nguyen. She's senior economist emerging Asia at Natixis. And she's put out a tweet, which we would like to highlight before we get to that conversation with her. So if you can just show what Trinh is saying. She's saying that for the BRICS places, or the BRICS nations, India is the big demand market. They sell more than they import as they have a surplus. Trump threatening 50% tariff on India makes Modi turn towards Russia and China and BRICS to solve the crisis. But India is the big demand market for BRICS. Now, and therefore, could the pieces be slightly different for the big demand market of the BRICS nations as the 50% tariffs come into effect in the next 24 odd hours? Trinh, great having you as always, and because you have such a keen eye out for trade and India and emerging Asia, would love to know how you think about this piece now that US has notified that the 50% tariffs will come into effect within the next 24 hours.
Well, the big picture is the war is not ending by tomorrow. So I think the 50% is here to stay, but they need to go lower, and they will go lower. So at the very minimum, we'll get rid of that 25% to settle at 25%. So the question is not whether, but how we get there and when. In the meantime, what is considered India's Achilles heel, which is limited exports of labor-intensive manufacturing to the rest of the world and to the US, is its strength. What that means is that export to the US is only 2% of GDP. The affected, which is removing exemptions such as ICT, pharma, it's only 1.2% of GDP. So assuming that we get a reduction of 50% of that, of 1.2, which is roughly 60 basis points hit to growth, as you mentioned. Now, that's a minor point, which means that for the Indian government to offset that, they will need to do tax cuts. And of course, the Indian banks will need to help the affected sectors. So what that means is that it's not a free lunch. There are costs. So the bond market is digesting this extra issuance that will need to come if they need to offset that. And also the banks also have to consider how are they going to help this affected sectors through interest rate, right? But we think that fundamentally, even if the short term is manageable, the long term is that India wants to change. It wants to grow this labor-intensive manufacturing part. It wants to export more to the world. And to export more to the world, it needs to export to high margin and big markets. That is the US and the EU. BRICS are important, but fundamentally, India imports more than exports. For example, its deficit with China is greater than 100 billion, right? While it has a surplus with the US. It has a trade deficit with every country in Asia except the Philippines. So for India, this diversification into Russia and into other countries is going to be very painstaking, meaning the future is still in developed markets to export more. So I think it will continue to liberalize. So the EU FTA is something that's under negotiation, and it will need to expand more in that market. We got the UK FTA recently. So the road for India is more trade, not less, even if we're looking at 50% of tariffs, and more trade with the US and the EU as well.
Trinh, point well made. The only question is we've waited multiple years, 4 years if I'm not mistaken, for that UK deal to take place, and we all know that there's a lot of back and forth in these trade negotiations. So what you're essentially saying is that in the next couple of years to 3 years, there's nothing dramatic that will shift on the external front for India. Is that the right interpretation? Unless something dramatically shifts with negotiations.
Look, the big picture for India is that it's a big domestic demand market, right? But the issue is that people continue to invest in India to access to its demand market. But India also wants to be a growth driver in terms of growing outward, right, to other markets. So I think here the tariffs will impact ambition to do that if it does not mitigate this 50% lower for the US, because that's the biggest export market for India and also currently in the world. So my view is that if it wants to grow this Make India part beyond just servicing India as a market, it will need to lower this tariff. How it does that is going to be a big question, because domestic politics dictate that Modi takes a very hawkish view, but fundamentally, he will need to find a way to lower the tariffs.
Right. Trinh, good morning. Hiral on this side. A way would be needed to lower tariffs, but if you have to talk about the domestic market, you've categorically said it earlier as well that the domestic market is India's prize. Now, how much of a buffer does the domestic demand provide against this direct economic impact of the 50% tariffs that we're talking about in terms of exports? How much will it be able to cover up for?
Well, the affected sectors are labor intensive, right? Which means a lot of jobs will be lost. Obviously, these are jobs that don't pay a lot. So one way to offset that, of course, is what the government's doing is with GST. Well, of course, they can do rate cuts as well, but rate cuts don't filter through to these lower income brackets that depend on labor intensive manufacturing. So fundamentally, there'll be some export supporting packages will need it for the local governments or the central government. What that means is this is not a free lunch to offset, right? There will be costs more into India. And this is just a short-term cost. The longer-term cost, of course, is job growth that's needed to absorb jobs that are incoming, demand for jobs, which is underemployed at the moment because informal job is most of the jobs, and formalization, even though it's increasing, is only 11%. And we have the largest population in the world growing massively. So demand pressure will be there. So the cost for India is not the short term, but the longer term. And I think that there's only so much the government can do to limit this because you need the middle class to grow. And you can't really grow that if you have job losses.
Trin, so some things are unfathomable. They will be dependent on a lot of moves that the government would make and reciprocal moves that other governments will make. So let's wait for those. For the near term, therefore, do you believe that if the economic growth impact is not so high, and because the Indian government, via both monetary and fiscal policies, so both the RBI and the government are taking steps, and we hear there are more steps in the offing to counterbalance the impact of tariffs as well as spur middle class demand. If all of those take effect, would the markets perceive that to be a net neutral to tariffs? And would you believe, Trin, that the economic impact too could get negated to an extent by stimuli provided by the Indian government?
Well, it depends on who you look at. The macroeconomic impact may be neutral, right? So you say, well, look, we're looking at 60 basis point hit. We're going to cut GST, and also we're going to perhaps front load rate cuts, targeted support for the sectors. All of this will neutralize GDP growth. But on a sectoral level, obviously, that's not going to be the case, right? Export-oriented sectors, particularly those geared towards the U.S., will feel a significant brunt. And the question is, how much support will they get? There will be some support, but is it going to be total? I highly doubt that. So therefore, I do think that the picture is the big picture. The devil is in the detail, of course. Macroeconomically, not a big deal. However, if you look at the bond market, it's digesting this, right? India was upgraded. So it should enjoy a significant rally from that because real rates are very high. But it's digesting on what the government's going to do if it cuts GST, right? And so that means that there is going to be more issues. So therefore, I think the response in the Indian market is going to be very nuanced, even if the macroeconomic environment is neutralized, so to speak.
It's interesting that you talk about the bond market, Trin. I think that there are increasingly Indian companies as a result of that review of the rating that are looking overseas for funding as well in the bond space. And I wonder what the appetite is for global investors looking into the Indian bond markets as well. There has been more interest in the recent past, especially in the context of falling yields in the US. Indicatively, they're expected to fall further. What is your opinion on that? Do you think that more flows will come through in the remainder of the year?
Well, I absolutely think that there's a lot of appetite for the Indian market. You know, the thesis for India doesn't change just because there's a 50% tariff. I think it does change if you're exporting to the US and you can't get this level down. And the good news for India and in general is that the share of export companies that invest in India right now to export the US is very small. Indian companies are still domestic oriented because there's still a lot of needs onshore. And so as a result, I don't see that to be a major issue. That being said, here the risk is that if we don't mitigate that, that will limit the opportunity for job growth, particularly for labor intensive sector. And worse still, we don't really know what Trump's going to do with pharma, right? Pharma is exempted right now. And the thing about the EU FTA is that it includes exemptions for the EU for incoming tariffs. And I think that makes me a bit worried about the fact that India, with this 50%, is not so much that what is being currently affected, but the future of India trade with the US in general and how it's mitigating the fallout from Trump tariffs. So as a result, I do think that fundamentally tariffs will need to go down. So that calculus tells you that while the short-term risks are not so large, if it lingers longer, it can be a big problem. It's a big problem in terms of the Indian government will need to do much more, which means that the rating upgrades can be limited if it continues to have a big fiscal deficit. The banks will have to take a bigger share of the losses of the export-oriented sectors if it wants to mitigate that. So it does fundamentally will have an impact. And as a result, I'm quite optimistic that at the very minimum, we'll get that 25% Russian oil tariff down to get us to about 25% level, which makes it very comparable to Southeast Asia. And maybe we'll get to the 24% level tariff.
Yeah, well, that optimism is what we will end this conversation on, Trinh. And, thanks so much for joining us as always. Pleasure speaking with you.